Okay, welcome everybody. Going to try to make a video here where I capture my screen and work through a problem. This is a problem from the back of the chapter in chapter 8. And I like it because it goes through a whole bunch of different topics in one problem. Got my headphones out to hopefully drown out my kids in the background. You'll probably hear some screaming, etc. If you're lucky, you might hear my son singing Dance Monkey. Okay, so I'm going to try to share my screen here. All right, so hopefully you can see what I'm doing here. So I've got this problem with John and Sandy Ferguson. All right, so I'm just going to go through this step by step. Now, I'll be honest, I didn't get this one exactly right the first time that I did it either. Right, there's a lot going on here. Right, but we'll just take it one step at a time. So John and Sandy got married 8 years ago. So right now I'm over here. I'm going to kind of keep track of everything I'm doing here as we go through. So something I can tell about them already, right? They're going to be married filing jointly. The filing status. They have a 7-year-old daughter, Samantha. Right, so unless it tells me something different later, I'm going to assume that they're going to get a $2,000 child tax credit. All right, so I'm going to keep track of credits down here for Samantha. Okay, so in 2019 tax year, John worked as a computer technician at a local university, earning a salary of $152,000. So that salary is going to be gross income. Sandy worked part-time as a receptionist for a law firm, earning a salary of $29,000. All right, so that's going to be more gross income. John also does some web design work on the side and reported revenues of $4,000 and expenses of $750. So I'm going to put the revenue here of $4,000. That's gross income. And that I know business expenses, right, from chapter 6 and chapter 9, those are 4 AGI deductions. So I'm going to put 750 business expenses. Okay. I made a little section down here for my other notes. I'm going to put all of his business information here. $4,000 of revenue. I'll put, and I'm going to subtract the 750 of expenses. So he's going to have net business income of $3,250. All right, that's going to be helpful, all right, when we have to calculate self-employment tax and QBI deduction. All right, so moving on. All right, I'm just gathering all the information and kind of putting it, organizing it. The Fergusons received $800 in qualified dividends. right? That's definitely going to be gross income, $800. This is the qualified dividends. And I'm going to make a note of the dividend down here when I'm thinking about tax liability. I want to remember that I have to think of this separately at its own tax rate. All right, the Fergusons got a $200 refund of their state income taxes, and they have always itemized their deductions. Their itemized deductions were well over the standard deduction amount last year. So all that means is that they got this money as a state tax refund, and we know they got a $200 deduction for that last year because of because they were well above the standard deduction level. So we know all of that refund has got to be gross income. State tax refund. All right, and they had qualifying insurance for purposes of Affordable Care Act, right? That's just right. So we know there's, no penalties or issues, tax credit stuff related to that. All right, so now we're going to see some of their payments during the year, AKA, right? These are things that they may be able to deduct. So state income taxes of $4,400, definitely something that's eligible for an itemized deduction. They had federal tax withholding of $21,000, right? That's not something they can deduct, but it is going to be a prepayment. All right, next, alimony payments to John's former wife of $10,000. And it is important here that they tell us the divorce was in 2014. That means before the law changed, right, this one, because it happened before 2018, that this alimony payment is a 4 AGI deduction. All right, child support payments for John's child with his former wife of $4,100, right? Child support is never income and it's never deductible. $12,200 of real property taxes. That's another definite itemized deduction. I'm going to just call this property tax. Sandy was reimbursed $600 for employee business expenses she incurred. Right, assuming her company did that properly, right? When she gets reimbursed those expenses, that's not income, not deductible, so nothing we have to do there. All right, $3,600 to Kid Care Daycare Center for Samantha's care while John and Sandy worked. So this, I should have pulled up the table with the percentages, right? It's something that you would be provided with on a problem. And so let's see, for credits, before we look up the percentage, all right, we're going to note here, all right, our first thing to do is take the qualifying expenses. So that's going to be the lesser of, right, earned income of the lesser earning spouse, but Sandy's income, right, is $29,000, or the actual expenses, $3,600, or but those actual expenses are limited to $3,000 for one child. So for any dependent care credit, we can only count $3,000 of expenses. And now we're going to have to multiply this by the correct rate. All right, so maybe I can just find the 2019 child and dependent care credit. All right, let's see what the IRS page says if they've got a, they're not going to make it easy for us. Let's check out their official publication. All right, here we go. This is going to have it. All right, so you can see here, let's zoom in. Right, once again, this table or just the percentage itself would be given to you on the exam. All right, so if I'm looking here, if they're AGI, right, we don't know their AGI exactly yet, but we can tell it's going to be over 43,000. So at that point, their percentage is going to be 20%. So let's put in, right, we took our 3,000 of expenses times 20%. All right, so that's going to give us $600 of a child and dependent care credit. All right, where are we at? Okay, so they paid $14,000 interest on their home mortgage. Their acquisition debt was $400,000. Since they're below the limit of $750,000, we can deduct all of that mortgage interest. $3,000 interest on a $40,000 home equity loan. They used the loan to pay for family vacation and new car, right? So under the current law, home equity loan interest, right, is not deductible, all right, unless you're doing major, right, remodeling or construction on the home. And so this interest is not going to be deductible. All right, next we have what do we see here? A $15,000 cash charitable contributions to qualified charities. Definitely a itemized deduction. And they have another, they donated used furniture to Goodwill. The furniture had a fair market value of $400 and cost $2,000. Right, so this is their basis. This is the market value. So, right, obviously this used furniture is worth less than they paid for it. Since it wouldn't generate a capital gain if they sold it, this is ordinary income property. And I'm going to go with the lesser of the basis or the fair market value, which here is clearly the fair market value. All right, so that's all of our raw information. And we want to calculate their 2019 federal income taxes payable or refund, including any self-employment tax and alternative minimum tax if applicable. All right, so let's plug in here and see what we're missing. So I should be able to calculate their gross income. All right, if I pull up a calculator, I should come to 186,000 gross income. All righty. There are 4 AGI deductions, right? This would be easy to forget, right, at this point, but since John has self-employment income, he is going to have some kind of, right, he can deduct the employer portion of self-employment tax. So that means before we can move on here, we have to figure out his self-employment tax. All right, so if we remember here, we had revenue minus expenses, and gives us net income from the business. So we're going to take that net income and we're going to multiply it by 0.9235, right, to give us the self-employment tax base. And that gives us 3,001. And I'm just going to round that right here. And now I want to take that and I got to think about what I'm going to multiply it by. All right, it's going to, because John has another job, I have to look up here. All right, so John has $152,000 of salary, right? So I can see he's already above the cap for Social Security. So his whole Social Security obligation is going to be met from his regular job. And that means down here for his self-employment tax, he doesn't owe any more Social Security. So all I have to do is multiply it by the double Medicare rate. Go here. So his self-employment tax should be $87. Okay. Now, if I take, right, half of this is his employer portion, half is the employee, right? And if we look here, I mean, I kind of skipped over this, right? His salary is $152,000, right? Sandy's is $29,000, right? For a married couple, they're less than $250,000, and so they won't owe that additional 0.9% Medicare tax. All right, that's why we didn't have to do that. And because there's no additional tax, our deductible portion is just going to be divided by 2. 4,350. We can round that up to, here we are, $44. Okay, so now I think that should be all of my four AGI deductions. So if I take my 44 plus the other 10,750, I should have 10,794 total. So now if I take my gross income, I'm going to make this negative, right? If I subtract that total 4 AGI deductions from my gross income, I should have $175,206 of AGI. Yeah. All right, so we'll move on to the itemized deductions. All right, so something that would be easy to forget here, bright light there, at this point, right, is state income taxes are deductible and property tax on their house is deductible. But, right, the total, right, this is going to add up to $16,600. But remember, the cap on the state and local tax deduction is $10,000. So that is what they're going to deduct here. And I'm going to make a note here. I can't deduct those full amounts, right? They're limited to the 10,000. Mortgage interest should be deductible. The charity should be deductible. So my itemized deduction should come to the 10,000 plus the rest. I'm going to try to Rain Man it here. That should all add up to 39,400 itemized deductions. All right, so how's that looking? Yeah, all right. Now something that would be easy to forget would be the QBI deduction, because John just had a little bit of business income. I may or may not have forgotten that the first time I did this. All right, so his QBI deduction, we're going to take, if we go down here, it's going to be based off of first his net business income down here. All right, 3,250. All right, that can't be more, if you remember, than his taxable income, regular taxable income minus taxable income before QBI. But we can see here, right, his AGI here minus his itemized deductions, right, is going to be much more than his business income. His business income was small, right, compared to his regular wages. So we are going to use the net income number from his business. All right, something, right, we'll say even though that's his technical net business income, we also, because he gets to deduct like a regular employer, the employer portion of self-employment tax, we deduct it from his employer portion, SE tax. All right, we have to subtract that. So his qualified business income is 3,206. That's called qualified business income. We multiply that by 20%. And we get $641. Okay, so that is our QBI deduction, right? So, all right, hopefully, right, we didn't even need to say this. Their itemized deductions are clearly bigger than the standard deduction of 24,400 for a married filing jointly. So they're gonna itemize. And right, either way, they also get to do the QBI deduction. So if I take their AGI, subtract the total itemized deductions, and subtract qualified business income deduction, I get to 135,165. Taxable income. All right, and now I just need to right, at this point, I would look at the tax rate schedule, right? And I'd use the formula for married filing jointly, right? Because this is already a long problem and I feel like everyone's got this down solidly, right? I'm just going to kind of do this quickly. But my first thing to note, right? All right, so if I'm talking about their tax liability, I have this $800 of qualified dividends. So I have to take that out of the full taxable income. I'm going to subtract 800. That means I'm left with 134,365 of ordinary. Right. So I'm going to take this minus all right, 78,950. Right, this is going to be in the 22% bracket. So it's going to be 12,191.30 plus 22% of the amount above 78,950. Right, that should get me 21,277 right there. The $800 qualified dividend. Let's see, I don't have the capital gain and gains and qualified dividends tax rates up, right? But if I did, it's probably worth pulling this out. All right, so if I look here, right, obviously this would be provided on an exam. We'll have to figure out how to do that on Blackboard. So if I look here, married filing jointly, I'm going to count their, right, ordinary, right, this 135, 365 first. That's going to put them well within this range. So the dividends will be taxed at 15%. Okay. So I'll take this $800 dividend times 15%, meaning we will pay $120 of income tax on the dividends for a total of, can Professor Cutler do this math in his head? 21,397. This is going to be a regular income tax liability. Okay. All right. Now, if we remember, the problem asked us also to think about one, self-employment tax, right? So we already did that, right? So we know self-employment tax is going to be $87, right? We calculated that down here. It also asks about the alternative minimum tax, right? And so I told you you don't need to know, right, how to do all the steps of that. One thing to think about, so all I would expect you to know is, right, one of the common things we add back, right, we would start with their regular taxable income. And the only thing we have to add back here would have been the state and local taxes they actually got to deduct. Right? If they took the standard deduction, we would have added that back. So their alternative minimum taxable income would be $145,165. And right, we would subtract an exemption. It wouldn't be phased out. We would multiply it by 26%. Right, but I'm not going to ask you to do those steps. What I want you to know here is that, right, if we came up with a tentative minimum tax for John and Sandy in this problem, it would be $8,561. So I'm comparing that to their regular tax liability, which we just calculated, right, was 21,397. Right, since their regular tax liability is greater than the minimum, they've already passed the minimum, their AMT, right, is 0. They're not subject to the alternative minimum tax, right? Most people won't be. All right, so now I'm ready here. I can take my regular income tax liability and I can subtract the credits and add the self-employment tax, subtract their prepayments, and see what I come up with. So if I start with $21,397, and I'm going to subtract, or in this problem, it doesn't really matter the order that you subtract the credits. Technically, these are, I'll subtract these before the self-employment tax, but it won't make a difference in this problem. All right, I subtract the credits, I'll add the self-employment tax. Now I'll subtract their prepayments, the withholding from their paychecks. And I get 2,000, let's see what I get, 2,116 negative. All right, so make sure that was what I wanted to get. Sorry for the delay here. Yes, that is what I wanted to get to. So, right, and that's because that's negative, right? Obviously, they've overpaid. That'll be a refund. All right, so we're in great problem, right, that incorporates so many of the different little topics that we've covered, from the deductions in Chapter 6 and the credits and the additional taxes in Chapter 8. And all right, so that's that. And I will post, I'll try to do at least 2 more of these sort of practice problems in the next few days.